Hi, thanks for joining me for my presentation on the bucket strategy, which is a popular personal finance management framework. Before I get started, I want to remind you that I am not a financial or tax professional. I'm not making any recommendations, endorsements, or offering advice. What I present is simply informational. Take what you like and leave the rest behind. You should always consult with your financial and tax advisors because your decisions are yours to make. Now, let's take a look at what we're going to cover today. We're going to open up with answering the fundamental question of what is a bucket strategy, followed by why use buckets. Then we're going to take a look at the most popular design of the bucket strategy, followed by challenges if you do get involved with the bucket strategy. I'm going to present an example and try to bring it to life, make it a little bit clearer before I wrap up. So let's begin by answering the fundamental question of what is a bucket strategy. Well, the way I define it is as follows. It's a way to categorize savings to meet spending requirements over time. And over time means over years. And it happens to be a good fit for retirement planning and is becoming increasingly popular among retirees. The most common bucket strategy uses three buckets. Money you need now, money you need later, and money you need eventually. The bucket strategy is popular because people find it straightforward and relatable. And keep in mind that the bucket strategy is also flexible. You can have more than three buckets. The bucket durations may vary, and you factor it when you factor in the value of your assets, age, income, and expenses. So why use buckets? Well, it's a great way to manage systematic withdrawals. You use cash and short-term liquid investments to fund current living expenses, bucket one. Also, it helps mitigate the risk of falling prey to behavioral biases such as following the herd, loss aversion, and confirmation bias. In other words, it helps you avoid selling when the market is low, and this is a really important psychological benefit. It can help reduce anxiety during times of market volatility, including sell-offs, crashes, and corrections. And many investors like the bucket strategy because it makes sense. That's because buckets are based upon annual living expenses and investments are grouped by category and risk, which provides peace of mind knowing that the money you need now is relatively safe. So here's what the design of bucket one looks like. And that again is money you need now. And for this example, we're saying it's money that you need in the next 2 years, meaning living expenses, one-time expenses. I always like to factor in some additional contingency. Now you can exclude or subtract out of that reliable income streams such as pensions, Social Security, or other income such as rental income. Now you fund the income gap with cash and short-term investments such as money market funds, floating rate funds, and of course cash. Now you can think of bucket one as a hedge against a market decline or sell-off. Okay, let's look at the design of bucket two, or money you need soon. Money you need soon is, in this example, money that you need in the next 10 years, or you're funding years 3 through 10. And you fund it with income producing investments. And we break that down into three subcategories of lower, medium, and higher risk. On the low risk side of income producing investments, you have bonds and CD ladders. And those should be duration, in the case of bonds, of less than 10 years. Also, government bond funds or ETFs. Now, income and producing investments with a little more risk include high yield bond funds or ETFs, preferred stock funds or convertible bond funds and ETFs, and balanced funds, which are sometimes referred to as hybrid funds because they're made up of stocks and fixed income securities. And in the higher risk subcategory, that includes equity income funds, dividend producing funds or ETFs, of course, and REITs, real estate investment trusts. Our third bucket is money that you need later, or expenses needed more than 10 years down the road. And I'm sure you can figure out at this point that you fund bucket three with longer term investments because the risk is greater the longer you hold on to an investment. And risk is greater for stocks and equity funds, real estate, or long-term bond funds with durations greater than 10 years. So with risks comes volatility, so that the money you have put out there in your more risky investment classes, such as stocks, is going to be subject to all that volatility, ups and downs. You can kind of shield yourself against all that anxiety because you're covered in the shorter term because you've got buckets 1 and 2 to live on. So the biggest challenges to following a bucket strategy are that there aren't really any tools to calculate the allocations across buckets. And there's not really financial reporting that's available by bucket. And buckets, like asset allocation, have to be rebalanced at least annually. So it's somewhat a manually intensive process that requires a fair amount of oversight by you and or your financial advisor. So let's take a look at an example that I put together to help illustrate the points that I've made. We're going to assume that the person is 55 years old, retired. Their portfolio is worth $800,000, and their annual expenses are $60,000. So we've allocated bucket 1 to equal $120,000, bucket 2, $480,000. So together they equal $600,000, or 10 times 60, $600,000. So we got bucket 1 at years 1 to 2, bucket 2, years 3 to 10, and that leaves $200,000 that falls into bucket 3, money that you don't need until after 10 years. So the way we've broken it down is as follows. In bucket 1, we have $10,000 in checking, $20,000 in a savings account, $40,000 in money market, and $50,000 in a floating rate fund, for a total of $120,000. And this is all hypothetical, of course, just to illustrate the points. Bucket 2 is comprised of a balanced fund of $300,000, a high yield ETF at $90,000, and an equity income fund of $90,000. In our third bucket, our furthest out bucket, 10 years out, the S&P 500 ETF, $100,000, the mid cap ETF of $50,000, and a small cap ETF of $50,000, which comprises our total of $200,000, $800,000 for the total portfolio. Now, I recommend performing a check and balance by coming up with a computation of your asset allocations. So out of all of these investments, cash and short-term, 15% of the $800,000. Fixed income, 26%, and equities, 58, almost 59%. Now, if you're 55, you may be comfortable, depending on your risk tolerance, with 59% in equities. But let's say you're not. Let's say you run that analysis and go, I really don't want to carry that much in terms of my longer term risk. I'd like to balance things a little bit differently. So I'm going to step away for a second, and I'll show you how by changing this investment, we can bring this number down and this number up. So what I did in this example is I replaced the equity income fund with an ETF. It's called IEF, and it's an ETF that is contained of the 7 to 10-year Treasury notes. So that $90,000 is now under fixed income, which has gone up to 32%. Equities have gone from 58.9 to 52.5. So again, what I really want to illustrate here was that you do sort of a sanity check of your bucket strategy by looking at your asset allocations, and then you can go in and make adjustments accordingly. So another manual step, but again, if you're into it, get your financial advisor to do it. If you're not, it's just a good way of making sure that you're happy with the way you've got your buckets invested and sorted out. Okay, so let's wrap up. Here's what I like about the bucket strategy, and other investors too, is it's something that's intuitive because you're basing it on your annual living expenses, and you're putting money into categories that are associated with time and your expenditures, which I think makes intuitive sense. And a really important one is that if you follow the bucket strategy, it's going to prevent you from making some really bad mistakes, because we all get really nervous and anxious when the market falls, and it always falls at some point in time. People make the classic blunder of selling low and buying high. So by putting your money into these safe categories, you can ride out the storms, because your stocks, which are your more volatile, more risky investments, they're happening, way down the road. So you don't sweat it. You don't pull the trigger and sell something when you shouldn't. And as I've been saying, you can have more than 3 buckets. Now, me personally, I happen to have 4 buckets. I have cash, probably 2 years of cash, and then I have a bucket where it's invested in fixed income, and that's maybe for 5 additional years. And then the other bucket that I've inserted in there are based on balance funds, the hybrid funds like Fidelity Balance, for example, or Berwin Income Fund. And that's another 4 years. And then I have everything else in there, that stock, equities, REITs, and that sort of stuff. So I find 4 buckets works really well for me. And the risk is kind of just the way it is. Bonds are less risky than balance funds, which are, less risky than stocks. And it works for me. I think it's kind of a neat way to set things up. So when the market's going crazy, I don't go crazy as well. And another kind of neat thing about buckets is you can set buckets up for goals, such as a vacation bucket or a college fund. So they have a lot of flexibility, and I think that's another neat selling point about buckets. So that brings me to the end of today's presentation. I hope you enjoyed it. I hope you got something out of it. I want to thank you for listening, and I look forward to seeing you next time. I don't know what I'm going to talk about next time, but until then, take care. We'll see you.